Good morning. Last time we have comments to do appraisal, credit appraisal. First, of course, we had discussed about consumer credit. We have discussed what are the major categories of credit. Consumer credit. In the consumer credit, personal loans. Those are short-term or medium-term loans. And even the mortgage loan, housing loans, those are long-term loans that also comes under consumer credit. These two are coming under consumer credit category. And then commercial credit, there are of course small and medium commercial loans and large scale or big corporate credit comes under commercial credit. Then the development credit, under this one, microfinance, microcredit, and then project finance. When we say project finance, those are SMEs, the loans granted for SMEs, small and medium, micro, small and medium scale enterprises, comes under development credit. And finally, international trade credit. This is the financing or providing credit for imports and exports. This international trade credit, though we saw a separate one, this also a commercial credit, but the type of credit facilities, there are differences. Because of that one, we are showing separately. Otherwise, the international trade credit also comes under commercial credit. So this, of course, we have discussed in our previous lecture. Then we started consumer credit evaluation. And 5C's concept or the tool to evaluate consumer credit, 5C's method, the tool we use, is of course developed by senior bankers those days through their vast experience to do the credit appraisal in a systematic way. Otherwise, you will be doing this one, that one, and everything. There won't be any end. So, for you to do the credit appraisal in a systematic way, they have developed this. We call it as a tool for the credit appraisal. So one is 5C's method. So what are those 5C's? Character of the customer, capacity of the customer, that is the repayment capacity of the customer, and then capital and his or her contribution, that is how much loan he expect from the bank for that purpose, how much he can contribute for the purpose, and then what is a collateral, the 4th C, what is a collateral he can offer for this facility, and finally, what are the conditions for these facilities? 5C's, purpose, interest rate, repayment, etc. All these conditions come and under conditions. So this is a 5C's method. This also we have discussed in detail in our previous lecture. So character of the customer we have discussed. That is very, very important, right? And then factual information about the customer to verify the character of the customer. What are the factual information we have to collect about the customer we discussed? Then customer's personal stability we have discussed. Age and health of the customer we have discussed is important for us to do the evaluation, the age and health of the customer. Customer's other factual information. What are the other factual information? That also we have discussed in our previous lecture. Then the capacity, the second C. That is whether he has the capacity to repay as it is now, whether it's a consumer credit. So present, what is his present capacity to repay this facility if the loan is granted. Therefore, we have discussed about weak borrowers, actually by Public Servant Ordinance and Sloan University Ordinance. I have explained that one. It says the total reduction should not exceed 60% of the gross salary of that employee. If the bank, after granting the facility, if you want to recover that facility through the pay sheet of the customer, through the pay sheet of the customer, then there should be the total reduction should not exceed 60% of the gross salary of the customer. If it exceeds and if the customer default, even you go to the court, you won't be successful. So because of that one, you must see the total reduction should be below 60% of the gross salary if you are recovering the loan through the pay sheet. But now, of course, what we are doing, we are asking the customer to remit the salary to his account and then we are recovering it. Then capital and its contribution is also we have discussed. Then the collateral, yes, we have discussed this one. It is an insurance to cushion the credit risk, if any. It is a safety net to be called upon only in the event of an unfortunate inability to repay the loan by the customer. Banker should never decide to lend if he thinks that he will probably need to realize the collateral. No. Actually, the first way out should be the cash flow of the customer. The first way out, if it fails only, we can go for the second way, that is a realization of the collateral. So always, before granting, you must see whether the customer has his repayment capacity. You have to establish that one. So when the banker decides to obtain the collateral, banker must establish availability of the collateral, where he should have a collateral. Then the marketability of the collateral. Can it be valued easily? Could it be sold easily if the need arises? If it is an asset, whether it has a stable value, and then enforceability of the collateral. That is, what is that one? The type of document to be taken. So various type of collaterals the banks are taking when they are granting facilities. For those various types of collateral, the documentation also differs. So you should know what is the type of document you should take. If it is a guarantee loan, yes. So if it is a mortgage loan, mortgage of land and building, or mortgage of machinery, or mortgage of vehicle, or mortgage of stock in trade, then what is the document you have to take? You should know. And not only that one, you must complete the document. The ability to complete the document without any shortcoming. So you should be able to complete the document also. You should know that one. You must develop it. Securities forever. Yes. EVER we discussed. E is easy to value. Then V, it is valuable. Then E, easy to charge, legally to charge the collateral. Legally to charge the collateral. So it should be easy. And then realizable when necessary arises. So you must realize it. You must realize it. So securities forever, EVER. Then the value of the collateral, as a general rule, the current value of the collateral must give sufficient margin over the amount of the advance. We call it rate of advance or loan to asset value. In the case of leasing, we use the term loan to asset value. That is, if the property, the value is say about 100 million, the banks has a rate of advance. Generally, 50% of the value of the collateral. 50% of the value. What value? For sale value of the collateral. That is the rate of advance. It's a property mortgage. The customer is giving a property as a security, as a collateral, mortgage of the property. Then the rate of advance, if the property value is for sale value is 100 million, so you can grant 50%, 50 million. But in the case of good customers, established customers, the rate of advance may increase. It may go to 60% or 70% or 80% or even 100%, depending on the customer's credit worthiness. Depending on that one, that will be decided by the management of the bank. So rate of advance, or other term, loan to asset value, especially in the case of leasing, they use this term. ideally, security should rise in value because the risk involved in lending increases with time. So, risk involved in lending increases with time. If you are granting a facility to the customer, first to installment he pay, and then he defaults, what will happen? Interest also will add on. Will add on. Interest also will add on. Then what is happening? The risk is increasing. Risk is increasing because interest also adding on. So ideally, the security should rise in value. In the case of properties, building, land, building, they always rise in value. So that is depending. So ideally, security should rise in value because the risk involved in lending increases with time. Consider whether there will be reduction of value of the collateral during the loan period. That is, even central bank instruction also. There, periodically you must revalue that assets. Collateral, you must revalue the collateral periodically. Central bank instruction is there. So you consider whether there will be reduction of value of the collateral during the loan period. Best practice to relate the nature of the collateral to the nature of the risk the banker has to undergo. What does it mean? Nature of the risk. Whether the nature of the risk is a short-term risk or a medium-term risk or a long-term risk. So to match that way, you must select the collateral. You must get the collateral. So best practice to relate the nature of the collateral to the nature of the risk the banker has to undergo. If it is a guarantee loan, yes. If it is a short-term loan, yes, you can accept a guarantee. If it is a medium-term loan, okay, you can accept a collateral. What is it? Machinery or a vehicle. Short-term, both are medium-term. If it is a long-term loan, then obviously you must get a property valuable collateral. A property you must take, land or building, the type of building, yes, you have to take. So the best, you must keep it in mind, best practice to relate the nature of the collateral to the nature of the risk the bank has to undergo. If it is a short-term risk, take a short-term collateral. If it is a medium-term risk, take a medium-term collateral like machinery, vehicle, like that. If it is a long-term risk, take a long-term collateral like property mortgage, land and building. So value of collateral. Then the conditions. So fifth C, condition. There are, of course, purpose of advance. You have to analyze the purpose of advance. Banker must know the purpose for which loan is sought and ensure the money is used for the same purpose. This also I have told you earlier, I have explained to you. When you are granting, you should know for what purpose customers seek this facility. That is one thing. And apart from that, after granting the loan, you must ensure the customer has used this facility for the set or approved allowed purpose. You must know. The reason and everything I have explained earlier, but there is only one exception that also I have already explained, that is personal loan. Actually, the HSBC has started that one, and then all other banks also followed it. That is, personal loan, you can use it for any purpose. That was their advertisement. You can use it for any purpose. The reason the personal loans are granted on the basis of their salary, on the basis of for the salaried employees, on the basis of the salary. So salary will be there. Because of that one, you take the loan, you use it for any other purpose. But in the case of other loans, you must know for what purpose the customer wants the loan, and you must ensure he is using the loan for that particular purpose. Banks have their lending policies related to purpose for which they lend. So banks have their lending policies. We have already discussed about this one. Bank have their lending policy. For what and what purposes they are granting. They are there. It is stated there in their credit policy document, which we have discussed. So, priority sector lending. Priority sectors, as far as Sri Lanka is concerned, agriculture, industry, export, fisheries, tourism, these are the priority sectors. So the priority sectors, government also want the concessional rate of interest. When compared to other, they want the banks would grant this facility with some reduced interest rate. So they must give priority for these sectors lending. So priority sector lending. Then not to lend to repay existing debts for speculative purposes, etc. Not to lend to repay existing debt. If a customer is having existing debt, so the bank policy not to lend for the customer to settle his debt, because you don't know whether sometimes that loan may get default. Similarly, speculative purposes. Speculative purposes means that also I have explained earlier, where you don't know whether what will happen, whether there will be income, there will be loss or profit, you don't know. Speculative. So for that type of thing, good example, gambling, then racing, those are speculative for those purposes. But there was an exception, I have told you, the margin trading, buying shares and selling. Margin share trading, shares, buying shares and selling. So in that case, of course, that is also sort of speculative. Sometimes you may gain, sometimes you may lose. But this for this purpose, for margin trading, that is for share trading, banks are granting facilities to their best customers, not to everyone, to their best customers. Why? Even they fail in this speculative share trading, they have other sources of income to repay the loan. Those customers have other sources of income to repay the loan. Because of that one, the banks are granting facilities to big customers for share trading, which is a speculative purpose. Otherwise, no. So, not to lend to repay existing debt or speculative purposes. In the case of existing debt, there is an exception. State mortgage and investment bank. Actually, that bank was started to safeguard some rural folk from the money lenders. These rural folks have mortgaged their properties to the money lenders, borrowed at paying at high interest rate, but they couldn't settle the loan. So what will happen? The lenders will take over the property. To safeguard those rural poor, the purpose of this mortgage and investment bank was established mainly for this purpose. This bank has provided loans to that type of customers to pay the money lenders and redeem their property and to mortgage to the bank. So this was there. Similarly, National Savings Bank also provide credit facilities to the rural folk for them to redeem their property which have been mortgaged to the money lenders. They are granting. Adjust participant complain kara right. So not to lend to repay existing debts or speculative purposes. But the existing debts, there are exceptions. The State Mortgage and Investment Bank and the National Savings Bank, they provide loan facilities to customers to pay their existing debts. That is, they have mortgaged their properties to the money lenders to redeem the property. They have mortgaged the properties to the money lenders at higher interest rate, so they are unable to pay back those loans. So to those people, these two banks are providing facilities to redeem the property, settle that one, and to mortgage to the State Mortgage and Investment Bank or the National Savings Bank. And then not to lend for illegal purposes, that is obviously. Legal purposes, the banks won't grant any facility. So this is purpose of advance, one of the conditions. The fifth C, conditions we are discussing. So when you are evaluating all these things, you must consider in a systematic way. In a systematic way. So it will be easy. Within short time, you can take the correct decision. That is, whether to grant the facilities or not. So for this purpose only, we are having this 5Cs method or 5Cs as a tool for the credit evaluation. Right. So one under condition, the fifth C, purpose of advance. Then, rate of interest and margin of profit. Rate of interest and commission to be charged are based on bank policy. This also again bank policies. We have discussed bank policy, credit policy document. It is there. Bank policy. Priority sectors may attract low rate of interest and less or no commission. Yes. So priority sectors may be on the request of the government, the banks may charge a concessional rate of interest, comparatively lesser interest than what they are granting for other purposes. So priority sectors may attract low rate, especially state-owned banks, that is IBSL and People's Bank, they are following this one, that is they always grant for this priority sector lending at a concessional rate of interest. So priority sector may attract low rate of interest and less or no commission. Yes. Then, a secured loan to a person of good standing may attract a low rate of interest. A secured loan for a good customer, credit-worthy customer, the bank may offer a lesser interest rate. In the case of corporate customers, they negotiate with the bank. They negotiate with the bank for the interest rates. They negotiate, and depending on the customer's creditworthiness and the credit worthiness, they may offer a lesser interest rate. A secured loan to a person of good standing may attract a low rate of interest. And then repeating customers may be offered low rate of interest. A customer who has taken the loan, repaid in a satisfactory manner, and then when he comes for the second loan, yes, bank may offer a lesser interest rate. I can remember in the case of bank loan, especially in the case of leasing facilities, when a customer obtained a lease facility, settled in full in a satisfactory manner, when he asked for another leasing facility, the one person they have reduced, bank loan reduced. So repeating customers may be offered low rates. Similarly, other banks also may do like that. If the customer is good, he is obtained the facilities and settled in a satisfactory manner, bank may offer low rate of interest. A loan to a risky purpose may attract a higher rate of interest. It's also based on the bank credit policy document. So sometimes some risky purposes, the bank may charge a higher rate of interest. If it is very risky, bank won't go for that facility. They may reject and decline that facility. But certain cases, they may charge, because it is risky, charge a higher rate of interest. Then repayment term. This is important for the bank. The banker is granting the facility. The repayment is very, very important. So the customer should have the capacity. The second C we have discussed. In order to check the likely ability to repay the loan, the banker must do 4 things. So check in the case of consumer credit. To check the customer's ability to repay the loan, the banker, what he should do, calculate the repayment with interest. He must know what is the repayment period. So what is the installment, the capital payment, plus the interest, he must calculate. Calculate the repayment with interest. Then obtain evidence for source of repayment. Yes, how he is going to repay this facility. From his salary, what are the other sources? Collect. And see, obtain evidence for source of repayment. Then deduct customers' outgoing from his source of income. What are the customers' regular expenditures? The outgoings. What are the customers' regular expenditures, outgoing, deduct from his income, ensure the balance is sufficient to repay. See, the balance is sufficient for the customer to repay. This is in the case of consumer credit. But in the case of other business loan, you will do various other calculation, debt service cover ratio, like that you will be doing, you will learn in your financial module, debt service cover ratio. So here in this case, consumer credit facilities, so these things, calculate the repayment with the interest, how much monthly installment customer has to pay, obtain evidence for source of repayment. So how he is going to repay, what is the salary or other income, rent or rent collection, or what are the other income. Then deduct the customer's outgoing, that is his regular expenditure, from his source of income. See the balance, whether the balance is sufficient for him to repay the loan. So these are the repayment terms you have to analyze. Bankers should ensure that the source of repayment is directly come to the bank. We have already told. So bankers should ensure the source of income, whether the salary or various other type of income, should directly come into the bank. The nature of the facility and the time scale for repayment should link with purpose and needs. Yes, the nature of the facility and the time scale for the repayment should link with purpose and the age customer, especially the housing loan. You must consider all these things. The nature of the facility, the time scale for repayment, but you are considering what is the time scale, whether it is 5 years or 10 years or 15 years. In the case of housing loan, should link with the purpose, housing loan, and the age of the customers. You must link it. Bankers should not consider lending to those who provide good security, but who does not have got resources to repay. Some customers may offer best security, but they do not have resources to repay. So you should not get upset. You should not grant that facility, because the first way out is cash generation, cash flow. Whether the customer has got resources to repay. The second way out only the collateral. So the bankers should not consider lending to those who provide good security, but who does not have got resources to repay. So these are the ways, the guidelines, or the tool for you to evaluate consumer credit. Pisces method. Pisces method. Character of the customer, very, very important. Capacity of the customer, repayment capacity, capital, and his equity, how much capital he is requesting, what is his contribution, equity, and then collateral, and finally various conditions. So systematically you must analyze and you can decide whether to grant the facility or not. So this is the tool for the consumer credit evaluation. But even for other type of credit also you can use this suitably. You can amend and you can use it. Right. Now other variation of 5Cs. Now some senior managers those days developed this 5Cs method. Similarly, some other senior managers developed various other methods also, various other tools for this they have developed. Right. There are various other methods or tools they have developed. One method is papers. P-A-P-E-R-S. P. Purpose. What is the purpose? I am not going to discuss everything in detail because we have already discussed 5C method. So similarly, you yourself can understand, analyze and understand. So P, purpose. For what purpose? First, whether it is illegal purpose or any accepted purposes, that way you will. And the A, amount. whether this amount, what is the amount, whether this amount is okay for this purpose. Then the period, how long he will take to repay this loan. And then expertise under that one. Customer's character, yes, what we have seen earlier, yes, customer's character, and then customer's commitment to repay the loan, or if he is doing any business, his commitment to the business, any enterprises, his commitment, and then capability, especially the business customers, especially for the business customers' capability you analyze, technical capability, managerial capability, and his financial skill, managing the finance you have. So this one, you can use it even for consumer credit or even for small business credit, business loans also. You can use this method, papers. You can use it for the consumer credit or even for small business loans also. You can consider this method. Then repayment. How is the repayment? How is the repayment? And then finally, is security. What is the security? What is the collateral? So the collateral is coming finally. After you are satisfying all these things only, if there are any risk, to cushion the risk, you are going for the security or collateral. So once again, the papers method, P, purpose, then A, amount, what is the amount he requests, P, period, what is the period of the loan, then E is expertise, his character, his commitment, his capability, especially for the business customers, his technical, managerial, financial skill, capability, and R, repayment, and finally, security or collateral. So this one, as I told you, you can use it for even consumer credit customers as well as small business customers also. You can use this method to evaluate their credit request. Then pass. There is another variation. Some other senior managers develop this. Pass. P person. Yeah, character of the person. Character. P person. First to analyze the character of the person. What we have seen in Pisces, the first one, character. Similarly, you analyze the person, his character. And then amount, what is the amount he requests? And the R repayment, how he is going to repay. How he is going to repay. And what is the period of repayment? You analyze. And then the security or collateral, what is the security? And then E expediency, that is, so business customers, his suitability. So his expertise, technical, financial, managerial. So for the business customers. And the remuneration, how much the bank will get, what is the interest? What is the interest? The remuneration. So this is a pass. So this also you can use it for the consumer credit as well as small business customers also. You can use this method. Pass. And then Campari. This is also a very popular method. In Sri Lanka, many people were using it. Popular method, Campari. This is another variation. Some other senior managers have developed. CAMPARI. C, character of the customer. What we have discussed in the Pisces method, character. And then A, ability to conduct the business and ability to repay. His ability to conduct the business, ability. And his ability to repay. And like M margin, that is interest. What is the interest rate? Then risk can return to the bank. How the risk can return to the bank? How the bank is benefited? How the bank is benefited? Then P, purpose. For what purpose? Whether legally or illegally? Yes, you have to. Then the A, what is the amount of the loan requested? And the R, repayment. How is the repayment? Analyze. And finally, I, insurance, that is the security or collateral. So these are the methods you can use to analyze evaluate the credit request, even consumer credit request or small business customers request in a systematic way. For you to do the credit evaluation in a systematic way. Right. That is consumer credit evaluation. And then commercial credit evaluation, that will be a separate lecture, but I'm just telling you. Yeah, of course, we call it 5 pillars of credit method. 5 pillars of credit method. What are the 5 pillars? Environment. Country's environment. Commercial credit evaluation. This is for the large scale commercial enterprises. Corporate credit. This is corporate credit evaluation. So environment. Country's environment. How is the legal environment, political, regulatory, social, economical, technological environment. Pestle analysis, we call it pestle analysis. We'll be doing it later. Anyway, for your information, I'm telling you. The pestle analysis, environment analysis is a pestle analysis you will be doing for a corporate customer. Then the industry outlook. So within the country, you environment analysis you have done, and then the industry. The company, customers' company is in an industry. So how is that industry? We call it industry outlook. How the industry outlook. Whether it is a matured industry, where it has achieved its growth, and further growth or expansion is limited, or it is a young and virgin industry, it has ability to expand, it can, yes, expand. So you analyze that one. Industry outlook. Competitiveness within the industry. How is the competitiveness within the industry? And then after that, competitive position of the enterprises. Now, first you have analyzed the environment and then industry outlook. How is the competition within the industry? And the third one, how your company is within the industry, the competitive position. Whether it is the top position or the lowest position or in the middle in between position. How is your customer company the competitive position within the industry? And then financial quality of your customer company, managerial quality of the customer company, and finally, if everything is okay, satisfied, then you structure the loan. You structure the loan. Yeah. Because in the case of consumer credit, maybe one loan, housing loan or a car loan, like that. And even in the case of small businesses, maybe 1 or 2 loans. But in the case of corporate credit, they want the different types of facilities to match their request. You have to identify that one. So we call it loan structuring. It's an important thing. Loan, so to match the customer, you have various type of credit facilities you have. Various types of credit we have seen, we have discussed. The banks they are providing various types of credit facilities, direct and indirect credit facilities to their customers. So you must select the best credit facility to match your customer's request. So for that purpose, we call it loan structuring. And then finally, collateral. So what is the collateral? And the quality of the collateral you will analyze. Collateral quality. So this we call it popularly known as 5 pillars of credit. But when you see, there are 6 pillars. Environment 1, industry outlook 2, competitive position 3, financial quality 4, managerial quality 5, finally loan structure and collateral quality 6. But actually the first 2, environment and industry outlook, both are common to the country. So environment also you are analyzing for the country. Industry outlook also you are analyzing for the country. So these 2 are for the country. So these two we consider as one. And other 4 for your customer company. Competitive position of the enterprise, that is about your customer. Financial quality, about your customer. Managerial quality, about your customer. Loan structure and loan collateral quality, about your customer. So the first 2 we take as common, that is for the country. So now we call it as 5 pillars of credit. There is 5 pillars of credit. Apart from that, there is another way also, financial and non-financial analysis. So out of these things, financial quality is also important, that we call it financial analysis. All others are non-financial analysis. So we may call it financial as well as non-financial analysis. That people used to say. Financial as well as non-financial analysis for the corporate credit customer. So this is commercial credit evaluation for the corporate credit customers. Then project loans. Project apply. These are mainly for SMEs, small and medium enterprises, SME. Project loan. Actually, in our program, this diploma program, credit management diploma program, we won't be discussing this one in detail. We won't be discussing, because there is another program, SME, diploma in SME financing, diploma in SME. There, of course, these things are discussed in detail. These things are project loan appraisal discussed in detail. So here, of course, we don't discuss this. Anyway, so what are the areas? Entrepreneur and management appraisal. Now, because these SMEs are the new one, young and virgin companies, virgin enterprises, young. In the case of other commercial enterprises, they would have been in the business for last 10, 15 years and they are going on. So these are very young, maybe 2 or 3 or 4 years old. So they may not have a history. So because of that one, they have to, this appraisal is something different. Project loan appraisal, entrepreneur and management appraisal, environment appraisal. You have appraise the environment, whether it is suitable for this enterprise. Technical appraisal, whether they are capable of doing this business technically. Market appraisal, then financial appraisal, and economic appraisal, whether this project is giving benefits to the country, benefits to whether they are employment creation, export potential, or import substitution, various other things we will consider. Economic appraisal. And finally, risk mitigation, how to reduce the risk, and loan structuring. Here also, you have to provide with various credit facilities. So loan structuring also important. So these are the project loan appraisal. We do it in this way systematically. Systematically, we will do entrepreneur or management appraisal, then environment appraisal, technical appraisal, market appraisal, financial appraisal, economic appraisal, risk mitigation, and loan structure. And based on that one, we take the decision whether to grant or decline. Okay, this is project loan appraisal. And then international trade credit. I have told you this is also sort of commercial credit. But here the type of credit facility is different. Because of that one we are discussing separately. But this is also a commercial credit. Imports and export. These are also commercial loans. And then appraisal techniques will be same as for commercial loans. However, type of products, facilities may differ and match the purpose. That is, whether import or export, for that purposes, the type of credit facilities will differ. So we use how we are analyzing the commercial loan, the same way, same method, or same tool we will apply for this international trade credit also. Right. Now, we are moving on to another important area, concept of credit scoring. Concept of credit scoring. So what is credit scoring? What is credit scoring? Please, you also please read with me and try to understand the meaning. Credit scoring is based on a system which predicts the future conduct of an account based on the past performance of similar account. Credit scoring is based on a system which predicts the future conduct of an account. So here the future conduct of an account means future conduct of a customer. future conduct of a customer. So, predict. So, we are using a system, a method, a system which predict the future conduct of an account. So, the system, we are using a system which predict future conduct of a customer based on past performance of similar account, based on past performance of similar customers. So we analyze past performance of certain customers by a system, through a system, and the system predict a particular customer how he will perform in future. So it is used by major financial organizations worldwide to help them to decide whether they can give credit to an applicant. So this method, this credit scoring method, used by many countries, used in many countries by the financial organization to help them, for them to decide whether they can give credit to an applicant. So they have developed a system. This is a system. The system predicts whether a particular person will repay or not. If we grant a facility, the system will predict if we grant a loan to a particular person, whether he will repay or not. So the system is developed on past performance of similar persons in the past. Based on that one, we have developed a system. So this is credit scoring. What is the basis of credit scoring? Credit scoring system is based on identifying key attributes of an applicant for credit. Applying, weighing points to those attributes, derive a credit score in numbers. So credit scoring system is based on identifying key attributes of an applicant for credit. Anyway, I'm just telling you how this was developed. Right. Actually, this was developed first in America, USA. There was a company, Fair Isaac and Co. FICO, FICO, Fair Isaac and Co. FICO company. They have developed this system. How they have developed? They have developed a statistical model. They have developed a statistical model. What the statistics do? Statistics, I think you would have learned even now, even in 6th standard, 5th standard, 6th standard, the statistics subjects are there. That is head or tail, coin, Venn diagram, the children are learning. The statistics. The purpose of statistics, it predicts. The statistics model predict based on certain basis. The statistical model predict. So here also, in this credit scoring also, they have developed a statistical model and use that statistical model. And the statistical model or the system predicts if you grant a loan to a person, whether he will repay or not. So the credit scoring system is a statistical model system. How they have developed? Fair Isaac and Company. Fair Isaac and Company, FICO. We call it Fair Isaac and Company, FICO, FICO, FICO company only developed this one first. They have selected about 60,000 customers who have obtained loans and repaid satisfactorily. They have selected 60,000 customers who have obtained loan and repaid satisfactorily. And then they analyze what are the common characteristics or features among these 60,000 people. And they had an assumption these characters would have been maybe the reason for their prompt repayment. So they have collected about 60,000 customers who obtained loans and repaid satisfactorily and analyzed their features, characters, and they have identified their common characters and they assume this may be the reason for their prompt repayment. Okay, they have listed. Got those things. Then, what they should do? Again, they have selected another 60,000 customers who obtained loan and defaulted. They have obtained another 60,000 customers who obtained loan and defaulted. Among them also they have collected their characters or attributes, rather character attributes. And they assume this attribute may be the reason for them to default their loans. So now they have attributes for the person to repay the loan promptly, one category. Then attribute of person to default the loans is another category. Correct. Analyzed. And by using that one, they have developed a system. Okay, so this way, the Pisces company, FICO, has developed this system. So it is a statistical model which is going to predict if you grant a loan to a person, whether he will repay or not. And you know now how they have developed this statistical model. Okay, now we continue. Credit scoring system is based on identifying key attributes of an applicant for credit and applying, weighing points to those attributes, derive a credit score in number. So when the customer comes for the loan, they have, actually from the attributes, they have given some numbers for the attributes. Applying, weighing points to those attributes. I have told you for the good customers who repaid also, they have the attribute. They have selected the good common attributes. For the customers who defaulted also, they have collected the attributes. And now they give points. They give points to those attributes and develop a credit score. A score is developed. That is in number. So now the Pisces company, by using this way, they have developed a credit score that is in number. Okay. For businesses, these attributes may include, so in the case of persons, there are various attributes. For person. But for the businesses, there may be some other attributes. The attributes may include sales turnover, profitability, number of employees, nature of business operation, number of years in business, its location or financial ratio. There are some other attributes for the business customers. For other type of customers, various other attributes they have developed. They have identified and they gave numbers, weighing, and they gave points, and total they have get the number. That is known as credit score. What are the basic features of credit scoring system? Credit scoring system was based on statistical model. I explain. These models were developed by analyzing statistics and selecting characteristics that are believed to relate to credit worthiness. That is, the people who obtain the loan and repay it. Good credit worthiness. The people who obtain the loan and defaulted, bad credit worthiness. A proper CS system, credit score system, should be statistically sound, reliable, and regularly validated. It should have high level of predictive ability. In USA, Pisces and Company is one of the institutions developed a model for credit scoring. We call it FICO scores. This model is now used in many countries. So if you want, there They have their website, myfico.com. You can go through and find out. There are different scoring models. So first, of course, the FICO only developed the model, but later other companies also developed. Yes, there are different models with different numeric system. Experian is one, and Equifax another company, Highmark another company. They also have developed this credit scoring model. Different lending institutions may use their own model. Even the lending institution also, they would have developed their own model. Different models may be used for different types of loan. So for the different types of loans also, there may be different type of credit scoring model. Credit card facilities, consumer loans, mortgage housing loan, vehicle loan. There may be different credit scoring system for different types of loans also. How the credit score is calculated? Right. Now I told you the FICO. FICO has developed a system by collecting these various attributes for the good customers as well as bad customers. So they have developed a statistical model. And they gave the points or numbers, and they have the total number. The number is from 300 to 850. So this credit score, FICO credit score, will have a range of numbers that is from 300 to 850. 850 means a good customer, credit-worthy customer, less risky customer. 300 means not a good credit-worthy customer, risky customer. So it ranges from 300 to 850. That is FICO model. That score going from 300 to 850. So when a customer wants a loan to a financial institution, which is using the FICO model, then the financial institution, get the applicant's various data from the application or from the interview. They collect the information and feed to the system. The system will analyze based on these customers' attributes. The system will tell whether his credit score is whether it is 300 or 400 or 800 or 850. That system will tell. Based on the attributes of the particular applicant, the system will tell. So this is the way. Now, how the credit score is calculated? In USA, there are credit reporting agencies who issue credit reports to individuals based on their borrowing, repayment of loans, and payments of bills, etc. These credit reporting agencies also calculate the credit scores to those individuals on request using the model. Right. Now, in Sri Lanka also we are using it now, but anyway, we see what happened in other countries. In UK, maybe your son or maybe your brother would have gone for studying. You may be remitting money for his studies. Okay. Then, of course, he will have his passport and he will have his visa to stay and study in UK. Then, of course, he can go to a bank and he can open a bank account. He can open a bank account with a visa and passport. In UK, he can open a bank account. Then you will remit the money will go to his account and everything. After some time, this boy may go to the bank manager and ask, I want a credit card. I want a credit card. He may ask the bank manager. Then the bank manager may say, okay, very good. You bring your credit report. You bring your credit report. So there are credit reporting agencies. Those are private agencies. Credit reporting agencies. So he can go to a credit reporting agency, CRA, and ask for his credit report by making a payment, heavy charge. to see this person has not obtained any credit facilities or anything. So they may give a nil statement, maybe. Okay, with that one, he will go to his bank there. So bank will look at him, okay, this person has not obtained any facility. Oh, he, of course, we don't know about his credit behavior, worthiness. Okay, anyway. Now we will give you a small facility, maybe £100. Just as an example, I'm telling you. Right. So they have given him a £100 credit card facility. Then, of course, he is going, using it. Maybe after 6 or 7 months, again he is going to the bank. Kindly increase my credit card limit. So the bank manager look at him. Okay, you bring your credit report. Again, he is going to the CRA, credit reporting agency, asking for this credit report. So credit report, of course, now he has a banking history. He has got a banking history. Now they will give his credit report. In addition, if the boy wants, they will give him a credit score also. Because the CRA, they have the facility to calculate the calculate the credit score of that particular person. So they will give the credit score of the particular person. So since he has obtained, if the person would have operated his credit card in a regularly in a good way, then of course there won't be any adverse marks or anything. He will go to the bank look at it, okay, no adverse points or anything. They may increase it to £200. It may go on like that. So they are the CRAs, credit reporting agencies. They provide the credit reports to the customers, as well as they will give the credit scores also on request to the customer. And same time, the banks also, they have their system to calculate the credit scores of the particular person. That is there. You can use it anyway. Anyway, in USA, there are credit reporting agencies who issue credit reports to individuals based on their borrowing, repayment of loans, and payments of bills, etc. I have told you only in the case of credit card, but in the case of some other customers, there are various other facilities. Yes, they would have obtained loans, they would have obtained credit card facilities and bill payments. All those things will be there with the credit reporting agencies. They will give. The CRA also calculate the credit score to those individuals on request using the model. Lending institution itself or third parties also in request calculate. PICO scores is between 300 to 850 assigned to a person. The higher the score, the less risky he is to the creditors. That is, he is credit worthy. So if the person, when he gets the credit score, if he is somewhere closer to 700 or 750 or 800, he is credit worthy. If he is somewhere 400, better not to go to the bank. He can go back to his home because bank won't entertain him because his credit score is very, very low. So individuals can obtain personal and other loan facilities from lending institutions based on these credit scores. This is happening in other countries. Credit score system. Why credit scoring? Why? Usual credit evaluation involves analyzing many factors, time consuming, and individual officers subject to error and to be biased. So now we have seen consumer credit evaluation or small companies, commercial enterprises credit evaluation. So many things you have to evaluate. It may take some time. So time consuming. And individual officers subject to error, sometimes they may make mistake. And sometimes they may be biased also. So when it is credit scoring, it is a system. So credit scoring concept is quicker. You have to feed the attributes, required attributes, you have to feed, and you will get the points. You will get. So it is quicker, cheaper, and more objective. So it is applied equally and fairly to everyone. No discrimination, not biased. So it is machine. No system. No bias, no discrimination. Less risky customers based on credit scores may be offered reduced interest rate, as we told earlier. So if the FICO score is very, very high, maybe 800, the less risky customer, the bank may offer him lesser interest rate for the facility which they are going to grant. To what extent it is used now? Early days, lending institutions adopted this technique secretly. But now every individual in USA can, in all those countries, even in India, may know his own credit score. Everybody knows. Even in Sri Lanka also, I'll come to that one. Yeah, if a person wants to know his credit score, he can get it. In other developed countries too, it is extensively used as an in-house operation those days. But now it is very open. It is used by these lending institutions for credit card, personal loan, house mortgage loan, commercial and SME loan. Now, insurance companies, telephone companies, and some service organizations also use the credit score to provide their services. This is happening in other countries because the insurance company, they want the insurance premium should be paid regularly. Whether the customer, for him, they offer the insurance facility, whether they will pay the premium regularly. Similarly, electricity company, they are providing the electricity services, whether the customer pay the electricity bill regularly. Other utility companies, they want to ensure whether the customer will pay their utility payments regularly. So now in insurance companies, telephone companies, and some service organizations also use credit scores to provide their services to ensure whether the customer is credit worthy, whether he will pay his payment regularly. What are the factors taken into consideration in credit score? Actually, FICO company, they have a lot of work and develop this system. So they won't tell you what are the attributes they have collected to. They have included in this, developing this model. They won't tell. But anyway, some basic things are available. FICO model in USA uses the following factors in respect of individuals. On a weighted basis, past payment history, 35% of the points. So if the customer has a very good past history, past payment, loan obtained and payment history, if he has a good history, 35% weightage. Amount owed, now how much he has to owe, 30% weightage. Length of the credit history, how long he is obtaining credit and repaying, length, 15%. Search for a new credit, whether this customer is searching for a new credit, that is also there, 10%. Overall credit missed. It is not a single facility or credit missed, depending on that credit card, maybe car loan, housing loan, other consumer credit, or maybe credit missed 10%. The total is, it is the lenders apart from this one weightage, the lenders in addition may take information from the application such as occupation, length of employment, whether you own a home, etc. to calculate the final credit score. In addition to this FICO, other information also the lenders may take and include. The final score, they will get it. Based on that one, they will provide the credit facility. So now, this you can see in our 5 C's also, there are things. The payment history, whether whether the customer is obtained facilities and he repaid. Past history of the customer. So these things similar to those 5 C's. You can see the resemblance between this one and the 5 C's method. Use of credit score in Sri Lanka. In Sri Lanka, many banks use the credit score system for their consumer commercial lending activities. These lending institutions use their own model considering various 11 risk factors, giving different weighting to calculate credit score of their customers. So this is one of the very old credit score system by a bank. This model for consumer loans considers the following areas in descending order of importance. Income of the customer, deduction, the age of the customer, past record. The one method they were using earlier. So just to see, just to show you how. Yes, area of consideration. If the income is above 100,000, score 35, 75 to 100,000, 30, 50,000 to 75, 20, like that, the score, depending on the income. Depending on the income, they have given some scores. Then the reduction, depending on the reduction. Total reduction below 40, as it is now, 30. Total reduction below 50, 20. Total reduction below 60, it is 10. If it is more than 60, no. Age, below 35 years, 20, 35 to 40 years, 15, 40 to 50 years, 10, over 50 years, 5. Then area of concern, past records. Existing credit customers with clean records, 15. Existing customers, no borrowing, 5. And then totally tap up and say score above 80, excellent. Score above 70 to 80, very good. Score 60 to 70, good. Score 50 to 60 is 4, satisfactory. Score below 50, weak, not to consider current facility. So based on the score, excellent, very good, good or satisfactory, they may limit the credit facility. How much amount they will grant. They limit the credit facility. This is one of the model, very old manual method. This is a manual method used by the some of the bank in Sri Lanka some time back. Right, now Credit Information Bureau of Sri Lanka. The Credit Information Bureau Act number 18 of 1990 as amended by Act number 8 of 1995 and Act number 42 of 2008. Credit Information, CRIP. So, providing CRIP reports, credit information of borrowers to lending institutions. So, their major function was providing CRIP report. In other countries, CRAs, credit reporting agencies, like that one. Here, the CRIP, Credit Information Bureau, providing CRIP report, credit information report to the lending institution. Here, of course, I have put some time back. In future, this institution may provide credit scores of borrowers to lending institution. No, now this institution provide credit scores also to the customers as well as bank. Now they have developed the system in Sri Lanka also. Now the credit score system has come and the CRIP, that is Credit Information Bureau, provide this system to the customers and to the banks. Credit score. Apart from that, if a person wants to know his credit report, he can go to the Credit Information Bureau, make a payment, give his identity card, and he can obtain his credit report. At the same time, he can ask, what is my credit score? So CRIP will calculate, will put in the system and give his credit score also. Now this system is there in Sri Lanka, and that system, even bank can request the Credit Information Bureau to give them the credit score of the customer. So based on that one, they will take decision. It is there. Actually, this was developed in within 2 years. This has developed in Sri Lanka. So now the Sri Lanka also in the credit score system, and each individual can know their credit score and the credit report they can obtain. Right. This, of course, I have done earlier. Branding also I have done earlier. Then other types of financial facilities. Now, certain financial facilities we are not discussing here in this system, in this program. So I am just mentioning something like that. Leasing and hire purchase in the financial facilities. Then venture capital. Then invoice financing or factoring. And finally, the margin trading. So margin trading, of course, most of the commercial banks are providing to their best customers that facility. And leasing, hire purchase also, the banks are providing. The venture capital, there are specialized companies to provide venture capital. and some companies, some banks have their subsidiaries to provide venture capital facilities to the customer. Similarly, invoice financing or factoring also done by some specialized financial institution, and some banks also have their subsidiaries to provide invoice financing or factoring. Right? So this is the one. The branding I have already discussed. You can see it is already, I have discussed the branding. Right. So this session is now over. We move on to the other one. Right. Now, we have discussed how to do the credit appraisal, especially in the case of consumer credit. We have done the credit appraisal. How to do, what is a tool or what is a method to do the credit appraisal. So there, of course, we need a lot of information we have to collect. We have to collect information about the customers. If we have those information only, we can do the credit appraisal or the evaluation correctly. So we need the information. So what are the sources of information and credit investigation? What are the sources of information? How can we collect this information about our borrowers, customers? That we are going to discuss now. Sources of information. Principal objective of gathering and analyzing information. So what are the principal objectives? Determining strong points about the applicant situation, about the application. When we collect the information, we know what are the strong points about the applicant. Recognizing the weakness in the application. Similarly, what are the weaknesses of the application or his application, applicant or his application? Learning about the operating peculiarities of the company and its industry. In addition, about the company and the industry where it operates. Operating peculiarities. What are the things we can? So by collecting the information only, you know about this company, about the industry where this company is working or operating. Determining which peculiar factors are crucial to the proposed borrower's continuing success. So when you analyze only, you know, what are the peculiar factors which are crucial for the proposed borrower's continuing business. Because the borrower, he has to continue in the business. So for that one also we have to analyze. So for most of these things, we need proper information about the customer or the borrower. Information gathering and analyzing, there can be a trade-off. That is, track record of the customer versus the amount of information. We have already seen the relationship banking versus transaction banking. In the relationship banking, we are developing a relationship with the customer, continuous relationship with the customer, and collecting the customer's information. So thereby, whenever the customer comes, we no need to go through from A to Z information because already we have the information. Additional information also, only we have to go for it. So if the track record of the customer, if the relationship of the customer with the bank is good, there can be a trade-off. Amount of information we no need to get much because already we have the information about the customer and the relationship with the customer is good and strong. So there can be a trade-off. So that you must keep in mind information and gathering and analyzing. There can be a trade-off depending on the track record of the customer and the relationship of the customer with the bank. Good loan decision making is the result of, so for you to make a good loan decision is a result of gathering as many facts as possible quickly about the applicant. It is clear. Determining which of the information is important and relevant to loan decision, and expertly analyzing and interpreting the meaning of that information, and finally constantly reviewing information to identify failure and success. This is also important. Constantly reviewing information to identify failures and success. Sources of information. What are the sources of information available for us to collect information? One is the applicant himself and his application. Then financial statement, annual reports, project reports, business plan of the customers, bank records, bank references from other banks, finance or leasing company, credit reports or rating, credit information agencies, credit reporting or rating agencies, and trade associations. So these are some of the sources of information. Informal sources, suppliers, buyers, customers, those are informal sources. The applicant's suppliers, his buyers or customers, his employees, his competitors, friends, relations, business circle, and bankers, informal sources. Then applicants, accountants, legal counsel, insurance agents, consultants with applicant consent. You obtain the applicant consent and consult these people and collect information about the customer. Then public reports, then media reports, current business information, newspapers, TV, business magazines, internet, and finally, interview and inspection. These are the sources of information about the customer. These are the sources of information. So from there, depending on the customer's nature of the business, you can collect information which will helpful for your credit evaluation or analysis. Applicant and application. Yes. What are the information you can collect from applicant and application? So application or the applicant may be individual, joint, and institutional applicants. For these applicants, there are different applications. Depending on the customers, different information will be called on. So what are the information you can find out from the applicant or application? Purpose and amount of loan. For what purpose is loan facility? What is the amount? And then identification. Personal or family, and enterprise information. Enterprise information may be business registration number, maybe a sole proprietorship or a partnership, then there will be definitely a registration number. If it is a company, incorporation number, that is registration number of the company, enterprise information. Then banking information, from which bank they are banking, which bank they are banking information. Then financial standing. What are the financial standing? Salary, income, expenditure, assets, liability, obligations. This information the customers have to, because when you go through the application, this information are cold. The customer has to fill and give. Actually, what is happening when a customer comes and give a loan application, maybe an individual or a consumer credit facility, when he gives an application, we just take it and keep it in the file and just wait. When the customer next time comes and asks, what happened, Mathya, mage loan application ke laana kotam tamai eka arang baranna wenna. That is wrong. So when the customer comes with the application, you ask him to sit and then just go through. It won't take much time, maybe just a few minutes. You must see whether all the cages have been properly filled, completed. If there is anything is not completed, you return it to him. Matya, meka karunagara me samburnama fill karlama denda. Samburnam. If anything is not applicable, you say not applicable. If anything is not applicable, what the information code is not applicable, you say not applicable, but it should be filled. Everything should be filled and returned. Then of course, when you have time, you can, when you do the evaluation, that will be helpful to you. You can do a complete evaluation. All the facility, all the information may be there. Otherwise, you have to telephone him. Matya, make it, again, that person has to come. You have to waste your time. He has to waste his time. No. So when a person gives a loan application or an application, you just wait a few minutes, spend a few minutes, see whether all the cases have been properly filled. Right. So financial standing of the customer. And then fifth and sixth, of course, I have left blank. What are the other information? You would have seen many applications. Just give me, in the case of individual, joint, and institutional applicants, what are the other information you would have called? Here, purpose and amount of loan, identification, personal, family, or enterprise information. Yes, banking information, financial standing. There are, of course, salary, income, expenditure, assets, liability, obligations. What else? Anyone? No one? Salary, income, expenditure, assets, liability, obligations. What else? No one? You haven't seen any loan applications?
Guarantor.
Sorry? Yeah, sorry, please repeat it. What is it?
Guarantor details.
Okay, yeah, very good. Yes, guarantors details. Collateral. Collateral. What is the collateral? Anyway, it is coming. The next one. Collateral offered. Collateral offered. It is coming. This is individual, joint, and institutional applicants. It is individual, joints, and institutional applicants. In the case of institutional applicants, companies, If the application is from a company, institution, what are the information?
Form 1, Form 2.
Director's information. So many. Director's name, address, age, their present position, director's information, and the share about what is the authorized shares, what is the paid up share, what is the issued shares. So many information. So now it is application in the case of individual, joint, and institutional applicants. So institutional applicants also. So information required in the application, purpose and amount of loan, okay, that is their identification, personal, family, enterprise, that is company registration or sole proprietorship or partnership, their registration numbers. Then banking information, that is the accounts, what are the accounts, where they maintain, all the details, financial standing, salary, income, expenditure, assets, liability, obligation. Then in the case of institutional applicants, there are directors' information, so many information. Directors' details. And their shares. How much is the authorized shares, share capital, paid up share capital, issued share capital, those details. And then collateral offered. Then only the security. Even in the case of personal application, the guarantor's detail, yes. Collateral offered. And then finally, the declaration. You know the declaration, not find guilty in a court of law, and whatever the things said above are true and correctly to my knowledge, the declaration will be there. This is applicant and application. So please take an application, maybe for the individual application, joint application, and the company's application, and go through it, or keep it in your file and look at it. So this will be very, very helpful to you. Documents submitted with application. Then with the application, you will be submitting the documents. What are the documents? Personal and joint customers. In the case of personal and joint customers, national identity card copy you have to give. Bank detail, salary receipts. This is for the consumer credit. Salary receipts you have to give. In the case of business customers, business registration certificate you have to give. And in addition, it is not there. If it is a local government license copy you have to give. That is Pradeshiya Sabha or Municipal Council, Town Council, Urban Council, they issue the license. Business license, annually it should be renewed. Annually it should be renewed. So that copy you have to give. In addition, certificate of incorporation. Certificate of incorporation, that is registrar of companies. The company would have been registered. Then memorandum and article, actually it is earlier, now only the article of association. Earlier memorandum and article of association, but memorandum is not necessary now. Now it is article of association you have to give. Then form 20, that is director's detail. Director's detail you have to give. And then there is a, what is the other one? What is the other one? I have put a his. I want the answer from you. A very important one. You should know in the case of companies, one important document, when they are applying for a loan facility, they have to give an important document. What is that?
Insolvency.
Sorry?
Insolvency.
Resolution. It is resolution. Companies resolution signed by directors and certified by secretaries, company certificates, company resolution. The company has decided to borrow this much of amount from this bank, this branch, for this purpose. So resolution, company's resolution. It's an important document you have to give. And then taxation details, payment slip or certificate. If you would have paid the taxation in Inland Revenue Department, the taxation payment, so the receipts, you have to give the copies, or sometimes the auditors pay on your behalf, your auditors pay the taxes, so they will give a taxation certificate that you have to give. What are the other documents? Do we have any other documents submitted with the application? Any other document when they own the facilities? Any other documents? In the case of personal or joint customers, the guarantors form, they have to give. And in the case of if it is a company's property mortgage and other thing, all the relevant document in regard to the property should be given. The bank will ask. Okay? Yes. What are the other documents? We will see other document also. Then the financial statement. Financial statement. That can be audited, unaudited, or draft. When we say financial statement, it is balance sheet as at particular date, a profit and loss for a period, and a cash flow for a period. You will give. It could be audited, unaudited, or draft. So this is for a particular period. The financial year generally from April 1st to 1st of 1 year to the next year, March 31st. April 1st of, if it is, now it is 2022. So from 2021, April 1st to 2022, March 30th. The financial statement for a period. The balance sheet, profit and loss, and cash flow. You have to give. So generally the bank asks for the last 3 years. Bank asks for the last 3 years, they will ask. So that means the bank may ask from 2021 April to 2022 March, and then 2020 April to 2021 March, and 2019 April to 2020 March. They may ask these 3 financial statements. So that can be audited, unaudited, and draft. Audited means the company has prepared the financial statement, and then by the company's accountant prepare the financial statement. Then it is perused by the company board, and then it will be given to the company's auditors, chartered auditors, for the audit purpose. Then they will go through it. If everything checked and everything, and finally, they will sign together with their opinion. Then the company's auditor, going through the accounts, the financial statement, they sign the document together with their opinion, then it is audited financial statement. Okay. Then unaudited. What is unaudited? Company's accountant prepare, company's board would have gone through it, handed over to the external auditors, chartered auditors, for audit purpose. The auditors have gone through the account, audited, but they haven't signed yet together with the opinion. They haven't signed yet. They have not signed yet together with the opinion. That means there could be amendments, there could be maybe some queries or anything. there may be amendment in the financial statement. We call it unaudited. Draft. Company's accountant has prepared it. Maybe the board would have gone through it, but not yet handed over to the auditors. It is draft. So based on that one, audited, unaudited, draft, you know. Audited financial statement is more corrected one. Unaudited, there could be corrections. There may be mistakes and that could be corrected. Unaudited. Draft means, yes, still the corrections not yet attended. Draft. So audited is more reliable. Unaudited is less reliable than audited. Draft is less reliable than unaudited. So as a appraisal officer, when you do it, the financial statement, you will mention whether it is audited or unaudited or draft. You will mention when you do your analysis, evaluation, credit evaluation, you will mention that. So financial statement, you will give. Obviously, the recent financial statement may be draft or unaudited, but the past financial statement should have been audited. So generally we ask 3 years audit, 3 years financial statement. Apart from that, sometime the financial year would have been over. Now, I said March, March 30th, March 31st, the financial year is over. Now, some few months would have passed after, from April 1st, few months would have passed. During that period also, the bank wants a financial statement. We call it management accounts. So this, of course, the financial year is not completed from the 1st April. Only few months would have gone. So for that period also, the bank may ask a financial statement. We call it management accounts to provide the management account. That also bank will use for this analysis. The management accounts also may be there. So these are the financial statement. From here, you will obtain the, actually we are discussing sources of information. We are discussing sources of information. So you can collect information from this. Then the annual reports. Annual reports of the company. Public companies. In the case of private companies, these financial statements they will prepare. In the case of public companies, they have to prepare the annual reports. So in the annual reports also, you can collect the information about those public companies. Chairman's statement will be there. Maybe you would have seen your own, the bank or finance companies where you are working. They would have prepared the annual reports. I don't know how many of you have gone through those annual reports. If you would have gone through, you may know what are the information available in those reports. Okay, I'm just going through. Chairman's statement will be there. So that will be useful for you. Chairman may say that we are going to do that one, this one. Oh, this year was something bad. We couldn't achieve. So those are the information for you to make decision. The chairman's statement, and then directors or CEO report, chief executive officer's report, general information of the business, and the shareholders' detail, auditor's report plus the financial statement, and then accounting policies, and notes to accounts, accounting policies, notes to account. What are the other information? Anyone? What are the other information from the annual report?
Objectives and goals for future years.
Yes, very good, very good. Objective, actually, vision, mission, values and objectives. Vision, mission, values and objectives. Yes. And the milestones in the past, what are the success achieved, all those things. Anything else? Anything else? Anything else? Yes, miss. Anything else? Market information, the risk faced by the company, risky situation. There are so many other things they will mention. Okay. Yes. So annual reports also in the case of public companies, very valuable information you can collect. Then bank records. Bank records. Performance of accounts. Bank records. So the customer may have the account with your bank. So performance of the account. Current account, maybe be a personal or business customers. Cash management, how the customer is managing his cash. Sources, how is the sources of income? How the users, how they are using? What is the amount? What is the highest balance, lowest balance, average balance, total deposits, withdrawal, and check returns. So these are now, of course, the system. No, those days, of course, people used to work manually. They used to go through and see the average balance. Calculation of average balance is a tedious job manually. But now everything computerized. With one switch, you will get all the information. So the highest, lowest, average balance, total deposit, withdrawal, and check returns. Then the cash deposit and use of credit cards. If it's a personal customer, use of credit cards. How they are using it. So cash management, how is the cash management of your customer? You can analyze. It will be very, very useful. Then deposit accounts. Whether they have a deposit account, savings account, whether they have the saving habits, what is their saving habits. Some people regularly they put some money to their saving accounts. And then loan accounts, credit card account, types of facilities obtained. What are the facilities they have obtained in the past? Honoring the obligations, how that is their repayment, honoring the obligations, whether it is regular or irregular. Then the default record. Actually, each bank will have a default record about a customer. So they are, of course, they have been stamped whether it is willful or non-willful defaulter. Willful defaulter or non-willful defaulter. This will be the bank records. Now, know your customer. Central bank instruction, know your customer. That is additional information. So other detail, the customer's business information will be there. So they can collect all these things from the bank records itself. You can collect so much information about the customer. Bank references. Bank references. Those days, of course, we used to obtain the bank references. If a bank there in Colombo, maybe Colombia, the customer, say bank A customer is asking facility from a bank A, then of course those days I am talking about those days. Then the Colombia bank A manager will send request to other banks, other bank branches in the locality, whether such a person maintain an account, whether has obtained any facilities from. So they reply, or maintain a normal account. Nothing, no signature, nothing, no data, anything. Right? Just send them, just reply like that. So we call it status report from other banks, finance or leasing companies. Calling for status report when a customer wants a bank facility from a bank, that bank branch calling a status report in the nearby bank branches about that customer. Status report from other banks or finance or leasing company. They provide an indication. They provide just an indication. Conduct of account and credit facilities about that one. So it is just an indication. They maintain an account, something like that. No other information other banks will give. So it is not comprehensive. It is not comprehensive. This is those days. But now, of course, we are having the CRIP report. CRIP report is very, very comprehensive, very, very useful. Okay. The bank references, it was not comprehensive. We were doing it earlier. Credit report. Credit Information Bureau then Dun and Bradstreet, DNB, and then Fitch International. So credit reports, we can call for credit reports from Credit Information Bureau, Dun and Bradstreet, International Organization, and then Fitch, the international, as well as in Sri Lanka also we have a branch. Right. Credit Information Bureau. I hope most of you would have seen CRIP report, Credit Information Bureau, their report, CRIP report. Available information. What are the information available in the CRIP report? Name and address, NIC number, the customer, and then information as borrower, as guarantor. Information as borrower, as guarantor. Also, the information is there. Then the facility type. What are the facility type? Whether it is a loan, or a leasing facility, or an overdraft, or a bank guarantee, or import facility, or export facility. So, detail. Right. What are the other information you can find in the CRIP report? I want the answer from you. At least somebody. What are the you? Somebody would have seen a credit report, definitely.
Indirect obligations.
Yes, indirect obligations. Yes, very good. Indirect obligations. Yeah. What else? I got the facility type. When you look at the facility type, in the facility type, what are the information? Name of the bank, the branch, date granted, amount granted, how much repaid, how much outstanding, how is the security?
Tenor,
Sorry,
period of the loans,
what is it?
loan periods,
Yeah, loan period. Yes, repayment period. Very good. Very good. Loan period. What is the present outstanding? Whether it is regular or irregular. So many. So my piece of advice, maybe you must be thorough with the CRIP report if you want to master this credit facility, granting credit facility evaluation and other thing. You must know the full detail of the CRIP report. Not only just looking at it, interpreting it. The interpretation itself will take, you have to learn by looking at, I can't do that, I can't do it in this class like this or the lecture. You yourself have to learn it. Take a credit report from your branch. You can speak to your credit officer or the manager. I want to look at a credit report and what is this? What is this? What is this? The interpretation, it's a very, very useful report for a credit officer or the manager about a customer. The CRIP report is very, very useful. So, and then all these things are there. And if a person is borrowed and if he is a director of the company, that detail also there. Personal capacity a person has borrowed. If he is a director of a company, that report also, that also included there. So many information. Very, very valuable information. And then it is available through internet. Now the bank manager has given a password. By using the password, particular customer's CRIP report, he can obtain. And then if a customer wants to get this CRIP report, he can go to the CRIP office, Credit Information Bureau office. He has to provide his identity card. They may charge a fee, and then they will give you your credit report where you are borrowing, and all these details will be there. And if you want, they will explain you also. As a customer, they will explain you and advise what things you can do like that. Even the credit card information, credit card, all the information are there. Facility type, very, very comprehensive information is there. So my advice, please, you all should know about it. credit CRIP report and interpret it. You must know how to interpret it. Now, credit rating. Credit rating. So this is also very, very useful. What is credit rating? Company rating provides an indication. So when they rate when they do the credit rating, that indicate the business strength of the company, vulnerability for internal and external factors. Yeah. So when a company do the credit rating of a customer, that credit rating, when you look at the credit rating, you can understand the business strength of the company, is vulnerability for internal and external factors. So this credit rating is carried out by international and local rating agencies. There are international and local rating agencies. One is Fitch International, and then Standard and Poor is another international, and Lanka Rating. This is local rating agency. They carry out credit rating of companies, big companies and even small companies, and they give their rating results. We will discuss it a little later about that one. So this credit rating also is a very useful information for you to carry out your evaluation, credit evaluation. Now the project report or the business plan. So the customers will give their project reports or business plan with the application. What they are going to do, what is their project, what is their business plan, they will give. So what are the important contents of the project report or the business plan? I want this from you. You would have seen project reports.
Operating cost.
Operating
Cost.
cost, yes, that is coming under financial liability.
Marketing plan.
Sorry?
Marketing plan.
Very good, very good. Yes, yes. Marketing plan. Marketing plan will be there. Financial analysis will be there. In the financial analysis, everything. What is the total amount required, the project investment, how much the loan facility request, what is the equity contribution, how is the repayment, what is the anticipated interest rate, what is how is the DSCR, that is debt service cover ratio, profitability ratios, liquidity ratios, all those things will be there. In a good project report should give all these information under financial analysis. That is coming under financial analysis. Similarly, means, as you said, market analysis. So in the market analysis also, yeah, a detailed analysis will be there. Right, what else? Market analysis, financial analysis. I have today morning, I have already discussed this one under SME projects about the project reports. I have discussed. Anyone? Yes.
Technical aspects.
Very good. Technical, yes. Technical analysis. Technical aspect, technical analysis. So if it is a agricultural project, yes, how the agriculture, land, water, irrigation, fertilizer application, and seeds, all those things, and harvesting, after harvesting, all those in the case of agriculture. In the case of an industry, the process, how it will be processed, all those information, details should be there. Technical analysis, very good. What else? Financial analysis, market analysis, technical analysis. What else?
What analysis?
Sorry? Yes, miss, please tell me.
Environment analysis.
Sorry, I am unable to hear you. What analysis?
Sir,
Sorry, I can't. I am sorry. Entrepreneur analysis or management analysis. Very important, no? Very important, no? Management analysis. Entrepreneur analysis. Very important. They will give who are the management team, and who is the entrepreneur, who are the supporting staff, what is the experience, what is the qualifications. They will give. So these are valuable information for you to make your decision. But you must check whether what they are saying in the project report is correct. So you must verify it. And if it is correct, those are valuable information. Management evaluation. Economic analysis. How this project is beneficial to the country. How many employment creation. How is the export promotion. How is import substitution. Economic analysis. Then what are the risky situation? Risk. What are the risks you can anticipate for this project? And at the beginning, how is the location? Where it is situated? So all these things. So when you go through the project report, if the given information are correct, so going through the project report, you envisage the project. And then you go for the inspection. That is other thing. So all these things will be there in the project report. So when the customer gives the project report, you have to spend some time and go through it.
Project description and the social responsibilities.
Project description and the
Social responsibilities.
yes. Very good. Yes. Cultural and social acceptability for the project. Cultural and social acceptability and the social responsibility. CS, corporate social responsibility. CSR. If it is a big company, that is also important thing. CSR, corporate social responsibility. So all these things will be there. Right. Okay, now we take a small break. Now it is 11:03. Shall we meet by 11:15? Now it is 11:03. Sorry, what is the time? Yes, 11:03. We meet by 11:15. Okay. Right. Thank you. Okay, let us continue now. Last we have done the project report, business plan. What are the information we can collect from the project report or business plan? What are the information we can collect? We have gone through it. Now the informal information. Informal information. We call it as a grapevine information. Grapevine information. The management word, informal information. So type of information. You can collect information, type of information. Sometimes the competitors may give information, the people who are working in the institution may give information, relations can give information, even big problems happen in big companies, even, the Reliance company in India, Reliance company, established by the father and the two sons, Ambanis. After father's death, among them brothers, there was a problem. Actually, finally, the mother has to intervene and she has to separate the businesses to both sons, different businesses to both sons. So the problem could be there anywhere, even in Sri Lanka also. I don't want to mention a very popular business. About the last year, after father's death, the brothers, of course, they separated it. So these things happen. So sometimes this type of information may come through informal information. So the type of information, what are they planning, whether there are internal problems among the family, or there are there are disputes, management disputes, whether the sales are dropping down, whether they are probleming in the production. So there are various types of information can come through the informal sources. So you must have the informal sources also to get these information. And the credibility or the dependability depends. So you have to analyze it. You can just take as it is in the information, informal information come. You should not take as it is. You must go through it, analyze it and see whether it is reliable, whether there is credibility in the information. Then only you can consider. So you have to verify. You can check with others. You can verify, you can check with others. So the informal information also you must have. You must give some weightage to that one. In the public reports, there are public reports. Central bank reports. Central bank publish various industries, about various industries. They publish reports. So if your customer is now he is asking loan facility, maybe for a big project, sometimes the central bank would have prepared some project reports in that particular sector. The particular sector they would have had report. So they have a very good library, the sales center, book sales center at the office. So you can go there, verify, and if it is necessary, you can buy and go through it, collect the information. Central bank reports. And apart from that, central bank annual reports. Central bank annual reports give various information about the industries, about agriculture, about various industries. So very useful. Then trade associations. So trade associations are there. Now exporters, Garment Exporters Association. Similarly, Tea Exporters Association, Coconut Exporters Association, Rubber Exporters Association, Vegetable Exporters Association, Ornamental Fish Exporters Association. There are so many trade associations. They also publish reports. They also publish annual reports, periodical reports. It may be useful. Chambers, Chamber of Commerce, Chamber of Industries. There are so many chambers. They also publish journals, reports about the business environment. And you can collect data from those things. Trade associations, chambers, yes. Actually, the Chamber of Commerce, it is there in the Navammavatta, somewhere closer to Navammavatta, there is Sampath Bank. So you can collect information from them about a particular business, particular sector, or particular industry. So reports published by Department of Commerce. They also they are in Navammavatta. They also publish report. Export Development Board. They also they are in Navammavatta. Export Development Board. So they also publish reports. Export Development Board. Apart from that, you can collect various information from the Export Development Board about the type of exports you can promote. What are the countries? Then Commodity Brokers Report. Yeah, this is not only the tea brokers report. coconut brokers report, rubber brokers report, commodity brokers report about the development of these sectors, about the present position of these sectors, the export values, export status, you can collect. And then share brokers issue company analysis. Yes, share brokers are there. They also do analysis, company analysis about some big companies. They do the analysis and public reports. They are very, very useful reports. So you can collect information from these public reports also. So, but you should know where you can collect. That is important thing. From where you can collect this report. They also give so many information about various sectors and industries. And then finally, apart from that, internet. You can collect information from the internet. So it is globally available. But the only thing I have seen, but sometimes some information are wrong. Some information are wrong. So you must have, you must analyze and see whether how far this information is credible, reliable. How far these information are reliable. Apart from that, really the internet information available in the internet is very vast, very valuable, but you must check and take the reliable information. Take the reliable information. After that one, after collecting from various these sources, then the importance of customer interview. So from the interview also, customer's interview also, you can collect information. From the customer's interview also, you can collect information. Importance of customer interview. So this is also collection of information through customer interview. Understanding the business operation. The owner of the business only can explain you his business operation. So which you can understand. So for you to understand, it is the business operation, the best person is the owner of the business. And then understanding the purpose and amount of credit requirement through interacting. Through interacting means you have to discussion with the customer. Actually, he may come with, I want about 50 million rupees to expand this business. But interacting, you can put question for this much time, for this much how much, for this purpose how much you want. By interacting, understanding the purpose and the actual amount of credit requirement. So with him interacting, you can make him also to understand. You can make him also to accept the actual requirement, credit requirement, and for what purpose it is. So understanding the purpose and the amount of credit requirement through interacting, and then verify available information. So he would have given various information, verify that one. By interacting with the customer, you can verify the information. Collecting additional information. Apart from that, by questioning and listening, you can collect additional information. And finally, understanding future plan and prospects of the business. So by interacting with the customer, you can understand the future plan of the customer and the prospect of the business. Is prospect of the business, you can understand prospect of the business. So for which, of course, you use the customer interview and interact with the customer to collect this information. Before the interview, check all the documents, including application and business plan. Check. Some managers, without doing anything, just call the customer for the interview. So the manager also don't know what he require, and the customer also comes because the manager may not ask the relevant questions. So manager himself or the credit officer himself should prepare himself for the interview. Check all the documents, including application and business plan. Then mark and highlight the shady areas and items need further clarifications in those documents and make notes to facilitate cross-checking. So while going through this document, there may be the shady areas. Certain areas in which not very clear, complicated. So mark and highlight the shady areas and items need further clarification in those documents and make notes to facilitate cross-checking. Prepare for an open and straightforward interview. So you yourself must prepare yourself for an open and straightforward interview. Okay. And I must, it's not mentioned there, not there. So when the customer comes, the customer may be a director of a big company. So you better go and give a handshake and welcome and ask him to make himself comfortable and put a casual talk in the interview. Straight away you should not start. So depending on the customer is a director or managing director or the owner of a big company. So you have to interact with him. So casual talk. So what is the condition? Today it is rainy day, it is very hot, the work is heavy or something like that, casual talk. And little by little, you start getting into the business information. You must do it in a tactful way. At the same time, you can order him what he prefer, tea or coffee or soft drink or whatever you order and honor him. And then start the talking. The interviewing. Interviewing means it is just talking with him and gathering more information. Getting clear in the shady areas. That is your objective. You must do like that. This, of course, the interviewing is a skill. Interviewing a customer is a skill. So you must develop itself. Now itself, you must develop it. Then, of course, when you after a few years, so you will be a very good manager, interacting with the customer, tactfully and gathering of information. So you must develop. It's a skillful. You have to develop this skill. Interviewing technique. It's a skill you must develop. Right. Then, if the interview, of course, the collecting the information, if it is satisfactory, then you go for the inspection. If you are satisfied at the interview, give a date and time for the inspection at the end. Okay, so now one by one. First, of course, we are going through is all the information, various reports, documents, and everything. Project report, business plan. You gathered information about the customer and his business operation and his business. And then you invited him for an interview. So there also you interact with him, gathered additional information, getting cleared certain information which was not clear to you earlier. If you are satisfied, you can go further. Then give him a date and the time for the inspection of the site or the project. If you are satisfied at the interview, give a date and time for the inspection at the end. There are two scenarios in inspection. Existing business or enterprise, new business or enterprise. So there can be two scenarios. One is existing business, already the running business, or the enterprise is there. Other one, a new business or new enterprise. Sometimes there won't be anything to see, only the land. The project land may be. Other things they have to develop in the case of new business or the enterprise. In the case of existing business or enterprise, there are already building, furnitures, machineries, office, quarters, everything may be there. So prepare groundwork for inspection. So before going for the inflection, you should prepare the groundwork. You have to prepare yourself. Prepare groundwork for inflection. Go through already collected information and make notes. Already you have collected the information, make notes. Items to be checked and details to be looked into based on the information available with you. What are the items you are going to check? And details to be looked into. What are the details to be looked into? What are the questions to be asked? The clarifications. What are the questions to be asked? Make a visit plan. You must plan your visit. You must plan your visit. Make a visit plan. Existing business. Inspection. So now you are going to the site. Address. The customer would have given you the address in the application. So you have gone to the site. Check the address. If the address is correct. Check the name board or name of business and address. Check the name board. Sometimes you would have gone to some wrong place, maybe. Cross check with the business registration. So check this name and the address with the business registration. Whether both are same. Check the assets and liability position. Check the level of operation. So you check the asset and liability position. What are the assets available? What is the liability? And the level of operation. This is an existing business. So check the level of operation. You check it. Present asset position. So check the asset position. Fixed assets, land, building, plant and machinery, vehicles, other fixed assets. You may have the list or prepare the list. Condition, the condition of the assets, fixed assets. Age, when did they buy those assets? And the capacity, if it is a machinery, the capacity. The building, what is the capacity? Whether they need any additional assets. If they are expanding the business, whether they need, you have to judge whether they need additional assets. In the current assets, fixed asset, in the current assets. Inventory, yeah, what is inventory? Stock, stock of item. The various type of stock. Stock in trade, that is for trading purposes. The trading companies, they have the stock in trade. Maybe sugar stock or flour stock or textile stock or garment stock. Maybe depending on rice stock, spare parts stock, depending on that one. Stock in trade. Or if it is a manufacturing company, stock of raw materials. Yeah, raw material, manufacturing company. The stock in trade, trading company. They have various, depending on the type of trading, they may have stock in trade. If it is a manufacturing company, yeah, depending on the manufacturing, they may have raw material. Then they may have finished goods. So from the raw material, they process and produce the finished good for trading, for selling. There may be in between. There are items in between. That is, raw material processed but not yet completed into finished good. We call it work in process. Work in process or working process. Work in process or working process. That is in between the raw material and the finished good. The raw material have been processed but not yet completed as finished good. We call it work in process. WIP. And then finished goods. And then packing material may be there. Packing material may be there. So collectively we call it inventory. When we say stock in trade, that is stock. Stock in trade. That is for trading purposes. Sugar stock, flour stock, rice stock, maybe onion stock or chili stock. Yes, stock. So stock of raw material, stock of work in process, stock of finished good, we call it inventory. American English, inventory, finished good. And then there may be packing material. is a collectively invented. And then there may be obsolete stock. What is the obsolete stock? Anyone in the class? Can you tell me the meaning of obsolete stock? Meaning of obsolete stock? A stock which cannot be used. A stock which cannot be used. Maybe in the case of trading, the date would have passed. Date would have passed. Or if it is a garment, the style or the fashion would have passed. Fashion is no more. Obsolete stock. In the case of manufacturing, obsolete stock, the raw material is obsolete, cannot be used. Date have passed, cannot be used. Similarly, finished good, date have passed, cannot be used. So obsolete stock. So when you do the inspection, this is of course gathering information by inspection. These are gathering or collecting information through inspection. So obsolete. So when you are going for the inspection, you must see whether they are obsolete stock. What will happen if the obsolete stock is there? These are the obsolete stock, the inventory. So your current asset value is which is showing high. Fixed asset and then current asset value. The stock also coming in the current assets. Under current assets, this will give enhanced value, but it has no value. You can't sell it. So what you have to do, you have to separate these obsolete stock from the current asset, and then take the value. This you have to be very careful. Whether there are any obsolete stock, the company or the owners may put that one also with the current stock and try to show you their current asset value is high. But if there is obsolete stock, that you have to take it out, separate it out, and take it out from the current asset value. So you have to do it, whether there are any obsolete stock. And whether there are any consignment stock. Consignment stock means there are certain manufacturers of items. They give the items to the traders for them to sell and pay. So manufacturers give the stock to the traders for them to sell and pay within certain period. We call it consignment stock. So the consignment stock also, sometimes they may show it with their current asset, but actually they are the owners of the consignment stock. Owner is somebody else that is given to them for the sale. So consignment stock also you have to separate from the current asset value. Consignment stock also you have to take it out from and then only you will get the current asset value. And sometimes mortgage to other bank. So some businesses, some customers may banking with maybe many banks, maybe 2 or 3 banks. So consignment stock, certain stock, they would have mortgage to another bank. But that also will be there in the building, that stock mortgage to the other bank also will be there. The customer may say this is also the stock value, and they want to mortgage to this bank. So that also you have to separate it. So when you are doing the stock inspection, there are 3 things you must identify. Whether they are obsolete stock, you have to separate it, take it out from the current stock, that is current assets. Whether there are any consignment stock, that is given by some producers, manufacturers, for these people to sell and repay within certain period. So if there is consignment stock, you have to remove it out from the value. And the stock mortgage to the other bank also may be there. That also you have to take out. This is, and then debtors. So this is under current assets. Now the debtors. Debtors mean the trade debtors. The people or companies have to pay to this company. Maybe they sell on credit. The item they are selling on credit. So trade debtors, the buyers of this item, they will pay the money later on certain credit term. They are selling the items on credit. This company, the company where you have gone for the inspection, is selling their products on credit to others. So they will be shown as debtors, trade debtors. They would have sold these products on certain credit terms, maybe 30 days credit or 45 days credit. On the term they would have sold. That money has to come to this company. That is shown as debtors. So there may be defaulted people. There may be defaulted trade debtors. Like our NPA, there also can be NPA position. So you must see whether there are any NPAs among the trade debtors of this particular customer. So what you have to do, you have to segregate. What is a credit term? If there are any trade debtors who have passed the credit term period, so separate them. They are defaulters, NPAs. Separate it. We call it age analysis. Doing age analysis. So you have to do age analysis. And separate those NPA trade debtors out. So otherwise, this also will give increased value of the debtors. The total current asset value will be inflated. Total current asset value will be maybe inflated because of all these things. Because of the inventory, that is obsolete stock, consignment stock, mortgage to other banks, and then trade debtors, defaulted trade debtors. You have to segregate them and separate them. Otherwise, this will give an enhanced current asset value. So, present asset position. Then the current liabilities. Current liabilities. What are the current liabilities of this company? Creditors. So, the suppliers of goods to this company, creditors. Maybe suppliers of raw materials to this company on credit term. So, this company, your customer is purchasing the raw materials or the trading item on credit. On credit. So, now the creditors will be there. Whether these companies paying the creditors regularly. So if they would have bought on 30 days credit or 45 days credit term, whether this company is paying them within that particular credit period, whether it is 30 days or 45 days, whether this company paying their creditors. You have to check. Otherwise, this company may be a defaulter. Overdue payment may be overdue by this company to their creditors. And then check the accruals. Utility payment, electricity, water, telephone bills, accruals. Check that one. Maybe 1 month outstanding may be okay. Sometimes there may be 2, 3, 4 months outstanding. Accrual, check. Whether the applicant's payments are regular. Whether your customer paying them, paying the creditors, paying the utility payments, regular. Check that one. And signs of overtrading. Signs of overtrading. What is overtrading? It's a very important thing, overtrading. I try to explain. Now, any business, maybe trading business, manufacturing business, or service providing business, any business, they have a target of operation. So just as an example, a manufacturing company. They have a target of producing 1 million units per year. Produce and sell 1 million units of certain product. 1 million units of certain product produced and sell. That is their plan. planned target for a particular year. So for them to produce, a manufacturing company, for them to produce and sell, they must have sufficient raw material to produce 1 million. Not one lot, throughout they must have. They must have 1 million to raw material. And other items, the labor, electricity, utility payments, and other things they must have. They must have. So, but for them to produce 1 million units, they must have sufficient raw material, and when they produce, they must have sufficient work in progress. They must have sufficient finished good. And if they are selling on credit, they must have that selling on credit. So the debtors, they must. To produce 1 million unit and sell 1 year, in 1 year, they must have. So what is this one? Raw material, in work in process, in finished good, and debtors, trade debtors. They are selling on credit terms to the customers. Trade debtors. So these 4 items are current assets. Raw material, current asset. Work in process, current asset. Finished good, current asset. Trade debtors, current assets. So value of all these total current assets should be sufficient to produce 1 million units of a product and sell. They must have sufficient, depending on the production capacity or production method. If they don't have sufficient of these items, they won't be able to produce and market 1 million units. So these items, what cash is tied up with these items. Raw material, you must pay and get the raw material. Cash is tied up. Work in process, no. There should be raw material, there should be people working. So cash is tied up. Finished good, no. Work, raw material, sufficient raw material, sufficient people labor, sufficient other electricity, other direct costs. Cash tied up. Trade debtors, cash tied up. So there should be sufficient cash tied up in the raw material, in the work in process, in the finished good, in the trade debtors. So sufficient cash tied up for them to manufacture and market 1 million units of products per year. This is their plan. So for that purpose, they must have sufficient current assets. Sufficient current asset means sufficient money tied up with the current asset. Okay. So this current assets, money tied up with the current asset, it's a term we are using, working capital. This is working capital, gross working capital. This we call it as gross working capital. The money tied up with the raw material, work in process, finished good, and the trade debtors. Money tied up with this item, current assets, is called as gross working capital. Now, for the company to produce 1 million unit of products annually and sell market, they must have sufficient working capital. They must have sufficient working capital. Okay, now they have the working capital. Say value of the working capital or these values, maybe say about 10 million rupees working capital to produce 1 million unit of product and market in a year. They must have. Now, they are expanding the business from 1 million unit. They are expanding it to 1.2 million unit. Produce and market. From 1 million unit, they are expanding to 1.2 million unit. They are expanding. What will happen? I want from the participants. Anybody who can just tell me what will happen. Actually, for them to produce and market 1 million unit of products, they need, say, I said 15 million rupees working capital. Working capital also I have explained to you. Gross working capital, value of the gross working capital, 15 million rupees necessary for them to produce 1 million unit and market. Now they have expanded it by 1.2 million units of products. What will happen? Anyone, please? This is a general question. Anyone, please? My God. Why? Somebody just say simply something say. It's a very basic question. To produce 1 million unit of item and market, they must have a working capital of 15 million. 15 million is, yes, necessary to produce 1 million unit and market of that product. But now they have expanded it by 1.2 million unit. They want to produce 1.2 million unit and market it. What will happen? What will they have to do? What will happen? What will they have to do? It's a very basic question. Anyone?
Selling price.
Sorry, yeah, please, yes.
Selling price will be increased.
Sorry, I couldn't. Sorry, once again, please tell me, miss.
Selling price will be increased.
Selling price, no. Yeah, they may increase selling price. Okay, that is later. For them to increase the products from 1 million to 1.2 million, they want to increase it. And
they need to increase their working capital.
Exactly. Very good. Miss, you are from which bank?
Nations Trust.
Nation Trust. Okay. But may I know your name?
Chaturika.
Sorry?
I'm Chaturika.
Very good. It's simple, no? It is simple. For 1 million units to produce and market, 15 million working capital necessary. But now they want to increase it to 1.2 million. What they have to do? They have to increase the working capital also accordingly. They have to increase the working capital also accordingly. If they do without increasing the working capital, if they try to produce 1.2 million, with that 15 million working capital, what will happen? There will be stress. There will be stress to the working capital circle. There is the working capital is circulating. Working capital means circulating. There will be a stress. So there may be breakdown. They are running short of cash. The enterprise will running short of cash. They need cash. Otherwise, without increasing the working capital, smooth run will never happen. So either they have to increase it, working capital. Without that one, there will be breakdown, running short of cash. Their checks may get returned. So many problems. That is called as over trading. This is called as over trading. This is what lot of people they try to do. without properly calculating the necessary quantity amount of working capital, they just increase their trading, or yes, just increase in their manufacturing without increasing the working capital. Then that type of customers only very frequently coming to the bank for overdraft. Temporary overdraft, Mahatmaya Mata temporary overdraft, salary pay karandone, raw material, minister given done, electricity bill given done. Again and again, they will run to the bank seeking short-term facilities. For that type of customers, you must say, look here, your working capital is short for this production and marketing. You have to increase the working capital, and the working capital investment is a permanent investment. Working capital is not a short-term investment. Working capital investment is a permanent investment. So that cannot be financed by short-term facilities. Short-term overdraft cannot be. A permanent facility has to be given. Maybe medium or long-term facility should be given to finance the working capital investment. So there are many customers running to the bank and ask for temporary overdrafts again and again. So obviously, if you try to do that one, if you help them, the business will crash. They won't be able to continue. So that could be done by a medium or long-term loan should be granted to them to finance the working capital. So this condition is called as over trading. And there is other condition, adverse trading, liquidity run, right? So this, of course, I hope today we stop with this one now. Maybe I will continue with the next session. I will continue this one. Okay, if you have any questions, of course, please ask me now. I'll be here for a few minutes. Any questions? Really, this overtrading, so what is the problem with the overtrading? What will happen? Runs out of cash. Then how can we use a technical term for this runs out of cash? Anybody? Miss, can you tell me this overtrading, that company or that customer is running short of cash? So what is another technical term we can use it? Very popular term is there, running short of cash due to overtrading. What is the term? Very often I am using. Very often I have told you also, this is very important. Yes, Miss, can you? Anyone else? This overtrading lead to what? Running short of cash. So the working capital has to be increased. So there is running short of cash. There is a technical term for that one. What is the term?
Liquidity.
Huh?
Liquidity.
Exactly. Liquidity crisis. Because of this one, liquidity. Miss, you are the same person? Hello?
Yes.
Okay, fine. Liquidity crisis. So overtrading will lead to liquidity crisis. Running short of cash to run the business. So liquidity crisis, I told you what will happen. In a short term, the business may crash unless it is corrected. In a short term, the business may crash unless it is corrected. Liquidity crisis. So this overtrading lead to liquidity crisis. And then we will be discussing then adverse trading and liquidity run. Those also lead to liquidity crisis. So these three things, overtrading, adverse trading, liquidity run, all these three will lead to liquidity crisis. We will next session we will see what do you mean by adverse trading, what do you mean by liquidity run. We will see in my next lecture. Okay, right. Thank you very much. If you have any questions, you can ask me. See about a few minutes. Okay, if there is no questions or anything, okay, we just wind up. Thank you very much. Thank you.